Hello everyone, welcome to the first recorded session of Aarambh Academy. Today we are going to study economics for finance, and I have curated this course in a manner that we will only be studying what we need for understanding finance and a little bit of marketing. Now, many of you might have the doubt that why do we need to understand economics for doing an MBA? Because quite frankly, nowadays no one is doing an MBA in economics, and anyways, if you are doing a master's in economics, then it's a very academics oriented role where you want to go into the academia, write research papers, and become a professor. That is only when you are studying economics in an MBA these days. There might be some exceptions, but that is mostly the case. So, why do we study economics? See, no company will exist in isolation, and economics is the study of the things that are surrounding the company and its activities, be it the customers, the demand from the customers, be it the supply of our raw materials, be it the acts of the government, be it the motivations of the government and the motivations of people. All of this can be understood to a certain level by economics. We can also understand the behavior of the customers, the behavior of the suppliers, and that is why we need to study this discipline. Now, coming to the start, if we were to specify why is it that finance need economics and what is the exact thing that we are getting out of economics, first of that could be the prices. The prices that we are getting of any product, so to say, is a combination or is a function, so to say, of the supply and the demand. Apart from this, the interest rates that are mostly set by the government, that are guided by the government, are also a part of economics. It's mostly about the demand and supply of the cash that the governments want to control. That decides what the interest rate will be. After this is the inflation. Apart from this, the capital flows, the rate of exchange of currencies, whether the currency that you are trading in will be more expensive or less expensive than any other currency. And apart from this, the rate at which your economy is growing. All of this is decided by the economy. And you, as students of finance, will have to understand these concepts before you start thinking about valuation, stock market, and all of these things. Now, what can economics explain for finance? The first could be you have to understand that whenever there is a depression in the market or whenever the market is in a boom, it is not because of some miracle that it is happening. For example, the first depression was seen in the first depression that we have great literature about was seen in the 1930s. That depression came because after the First World War, there was a very big boom. And in that boom, there were many things that the government should have taken care of, but they didn't. And that is why the 1930s depression happened. Even if you take the look at the fall in the stock market in 2020 and its over recovery after that, that was because of the COVID pandemic. Apart from this, whenever you're doing a business, you will also take a look at your capital structure, whether you are borrowing money from a bank or are you giving out your stake in the company. That is a function of borrowing, the rate of interest. That is also something that will come from the economy. It is not something that is a core finance concept. Apart from this, most of you will be going to work in an will be going to be working in an MNC. MNCs, of course, by definition, are working across borders. Now, how money is flowing across borders? What is the SWIFT banking system? What exactly is the interest rate difference? That all again comes back to the economy. And finally, whenever we talk about strategy, that is a very common term. Most of you might want to go into strategy consulting. We think of competitive advantage. So why is it that one firm is earning more than the others? Why is it that one firm has competitive advantage? That is also decided by the economy only. Now, if we were to study economics in a singular manner, it will become very difficult. Just as an example, if you were to study science in its entirety, it will be very difficult. If you were to study English in its entirety, it will become very difficult. So that is why we split subjects. Science can be split into multiple disciplines, but uh, roughly it is divided into three disciplines, that is physics, chemistry, and mathematics. English or any other language is divided often into literature and language. Similarly, economics can be divided into two concepts. The first is microeconomics and the second is macroeconomics. Microeconomics is about the behavior of individual entities, be it a firm, a company, or any individual who can be a customer or a supplier. Now, when these things are aggregated to a national level, when there are multiple individuals and we are aggregating or integrating the behaviors of all of these, then it becomes macroeconomics. When we are talking about microeconomics, we have terms like firm behavior or propensity to spend of a particular person. But when it comes to macroeconomics, we talk about the growth of the economy. You might have heard about the GDP growth rate or the inflation in the economy, the interest rates, the policy, currency evaluation or depreciation. These are the things that we are talking about in macroeconomics. So if anyone asks you what is the difference between microeconomics and macroeconomics, the difference is very simple. Microeconomics is the economic study of individual elements in the market, in the economy, whereas when we aggregate them to a greater level, it becomes macroeconomics, where we are discussing about the behavior and properties of a whole rather than a single individual, be it a company or a person. Now, the first idea of finance or first idea of economics that we are going to look at is scarcity. Now, why are we studying about scarcity? This is because there is a key problem in economics, or let's say there is a key problem in the world that we live in. The wants that we have, for example, any one person will need to have a very big house. Okay. Apart from this, you want some amount of cash in your bank. You want some amount of gold jewelry. Okay. Now, is this want limited? The answer is no. Once you get a small house or even a big house, you want a bigger house. You want to move into a more posh or more expensive locality. When it comes to the money in your bank, then there is no way that you are satisfied with that money. You are always running behind more money. Similar thing is with each and everything that you need, each and every demand of yours. But if we were to take a look at the supply is always restricted. There is rarely a case when the supply is lesser than the demand in the long term. Most of the times what happens is that the demand far, far, far outweighs the supply. And that is why in the long term, the prices are rising. Now, that is what we have summed up here. Capital is limited, but opportunities or the need is unlimited. That is why we have scarcity. So in essence, what we can say is that when a huge number of people are running behind a commodity, which is lesser in number or lesser in amount, so that such that it cannot fulfill the demand in the market, that is when scarcity is created. So what we do is that let's understand it like a story. We are trying to buy something. Okay. Now, first case is that because there is scarcity, you have to pay a price for it. Okay. So let's say you want to buy gold. You bought gold. Okay. Because there was a scarcity in the market, you paid more than what you had to pay last year. Okay. But in buying gold, it's not like you bought gold and the returns that gold is giving you, that is around, might be just an example, might be around 8 to 10%. It's not like that is it. If you want to buy gold for an investment, there is another thing that you have to look at. When you are buying gold for, let's say, 1 lakh rupees, you are foregoing something. You are leaving the 6% rate of interest rate, 6% per annum interest rate that the bank was giving you on an FD. You are giving away on 13% returns from the stock market that you might have gotten directly from a index fund. So what is this? For example, even if you take a decision, you decide to do an MBA. What are you letting go of? It is 2 years of your time, particularly 2.5 years of your time you are giving away to do this degree. Now you have decided to do this degree. Why? Because you have found out that if you do these 2 years of degree, then MBA is the best option for you because it will get you a job in the future. But that is not the case everywhere. Just take an example. For just taking an example, there is a fresher who has no work experience and will not be able to find a good job. And then there is a person who is already working in a very good role, very big role in a very big company with a salary of 30 lakhs per annum. Now, will a person who is already earning 30 lakhs per annum, will he give 2 years of his time and pay 30 lakhs in for an MBA for a college that will offer him 35 lakhs of package on an average? The answer is no. Why? Because his opportunity cost is 30 lakhs he would earn in 1 year, 2 years would be 60 lakhs, with some increment that would have become 70 lakhs, plus the 30 lakhs that he gave. So his opportunity cost is 1 CR. Okay. His opportunity cost is greater than his earnings. That is why he would have not decided to do an MBA. So this is called opportunity cost. When you are deciding to take something, you are also deciding to not take something from the money that you have spent. That is called opportunity cost. Okay. Now, why is it that opportunity cost matters? See, why opportunity cost matters is because you don't need to, just the fact that you made a profit out of an investment is not enough. Okay. Suppose you invested 1,000 rupees in the market. Okay. Anyways, you would have earned around, what do they call it? 6% of 1,000, that is 60 rupees from the bank in a year. But if you make a profit of 1%, that is 10 rupees in a year, will you be happy? The answer is no. Why? So, as I was saying, earning 10 rupees from a stock market is not enough, because anyways you would have earned 60 rupees on the market and you took additional risk. So the point of your investment is not to just make money, it is also to make more money than the next best option from the for the same amount of risk that you are taking. Apart from that, there is also one more thing. For example, you are the chief operations officer of a company and you decide that you need to expand into a new geography. Let's just take that you are the brand manager, or let's say the chief operations officer of Nescafe. You decide that you need to expand into a South African country. Now you need capital for this. You took a loan from JP Morgan bank or some other bank, any international bank, to do this. Now they have given you that money at a rate of interest, at a 5% rate of interest or a 6% rate of interest. So anyways, the profit that you make or the return on investment that you are getting from expanding into that market in the long term should be greater than the money that you took it for. That is called the investment's return being greater than the cost of capital. Okay. Now, since we have got that covered, now we will try to understand the demand and supply. This is also a core economic concept, and we see the demand and supply equilibrium like this. Wherever the demand and supply matches, that is what the price of the commodity will be, and that is the quantity that it will be sold in. Okay. So for example, you take a look at salt. Salt is a more sort of a commodity. Now you might be thinking, what is this commodity that sir is constantly saying? There are two types of things. One is commodity and one is product. Okay. Fridge is a product, because fridge has a huge impact of what is the brand of that fridge. The product in itself derives a lot of value from the brand, from the source. Whereas salt itself is just salt. No matter who sells simple plain NaCl, that is sodium chloride salt, will not be able to charge too much for it, because the value for sodium chloride as an element is pegged. Similarly, gold is a commodity, but gold jewelry is a product. So anything which is can be traded, irrespective of who is selling it, the price is not determined by the seller, is a commodity. Whereas a product in which the seller's brand worth matters, that is a product. Now you might say that in gold also, the worth of the seller is there, because then we know genuineness. That is not what you're taking into account. If you are sure that you are getting 100% pure gold, will it matter who is selling it to you? It doesn't matter. But if it's a case of a fridge, it always matters which company the refrigerator is of. Okay. Now prices of a product are again decided by supply and demand, and that is how you will be deciding the worth of your products. Now, what happens in the market is, this is what you have to take into account from finance, or let's say from economics. The demand and supply has a lot of shocks that are there throughout time. Okay. For example, if the price increases, the demand will definitely decrease. Okay. Now, what is the one reason that from which the price can increase? First is taxes. Okay. Taxes can increase the price. Then input cost. Assume you are making refrigerators and the price of aluminum skyrockets. Then the price of the refrigerator will also go up and the demand will come down. Regulations. If someone says that now in the refrigerator you will have to add a certain element that is expensive, again, because there is a change in regulation, the price are increasing. Then there is policy changes. Someone says that you will only be able to sell above 3-star refrigerators for electricity, saving electricity and for the environment. Okay. That is again a shock. Now, uh, understand that this is the thing in the market. Now, how will you see it in your financial aspects? So, what will happen in finance is, or in the financial balance sheets or the statements, is that the revenues, the profitability, the valuation of your company, these will take hit. Okay. You will see that these things are happening, that the revenue went down 3% this year, or the revenue growth went down this much, the profitability reduced, the valuation is going down or coming up. From this, you will have to figure out what happened on the economic side that this happened, and how can you alleviate these concerns and ensure that the revenue, profit, and valuations are going up and up only. Okay. Now, how can you use demand and supply in marketing, or let's say in your jobs? First is the rate of growth of the economy will decide the rate of growth of your company. Apart from this, there are various models in FMCG market that will help you decide what the price of your product should be. So if the interviewers ask you what exactly is the reason that you need to study economics, or how is supply and demand relevant to this particular aspect, you will tell them that the pricing is often decided by supply and demand, and we will be able to forecast the revenues. There are various models like the DCF, the discounted cash flows, that help you in taking out a valuation. Okay. After this, what is margin? This one is important. Margin is the amount of profit that you are earning per 100 rupees spent. Okay, that is margin percentage. That is the profit margin. And you need to understand that for a business to be stable for you, the margin needs to be stable. It's not like that one year you earned 20% profit and the next year for the same amount of money spent, you are making a loss of 30 rupees. Then this business is not viable. What you should do then is maybe hedge the markets or look for a different business. Now, taking a look at market structures. What is a market structure? See, let's take three examples. One is Russia. Okay. Other is India. Okay. And third is USA. Now in USA, we understand that the market is very open. It is a totally free market. Whereas in Russia, the market is closed. It's an oligopoly. And in India, the market is in the middle. If we were to take a look at another aspect or another subset of this market, let's take a look at the telecom market. USA has a free market. There are multiple players. Russia has an oligopolic market where there are a few players who are very close to the government and can decide the prices. Whereas in India, it is a monopoly or a duopoly market where you can see that two or three players are dominating the market. So if you were to invest in telecom, which country will you go into? You will of course go into USA. This again you can deduce with the help of economics. Now, how will you understand this? You have to understand what kind of market is your target market. If it's a free market, then you go into that market and start making profit and start working hard. If it's an oligopoly market, then you try to look for connections. You try to look for different ways in which you can, let's say, try and run your business. And if it's a monopoly market, then you don't try to enter this market unless you have something very innovative. Okay. Now you can see this is summed up here. There is perfect competition, there is monopolistic competition, there is oligopoly, and there is monopoly. So if you are entering a perfect competition, then you can see that the deciding factor of buying a commodity or a product or a service is the price. In a monopolistic competition where there are two or three players, then you have to focus on differentiation. If it's oligopoly, then there are few powerful players. You can either join them or try to become one of the more powerful players by being close to the ones who are making you powerful. And if it's a monopoly market, then you better look for a different market. This can be used in case studies when they ask you that we have this product and we have to expand to a market. Then you can, to the professors, you can say from your own end that, sir, if it's a perfect competition, then what we can do is that we can just enter and try to reduce the price so that there is greater acceptance of our product. And then we can start increasing prices slowly and slowly so that we can start making profits on a broader customer base. If it's a monopolistic competition, then you focus on innovation. If it's oligopoly, then you try to become close to the people in power so that you can get tenders and other things. Whereas it's a monopoly, then you avoid that market. As you can see, I have told you what you can do in each and every market. There is no need to repeat that. Now, the question is that why is it that the market structure matters as a person who is interested in finance? Again, the assumptions that you take for valuation. When you are evaluating a company, you are taking two or three things in mind. The interest rate, then the growth rate. After this, you take a look at the risks that are there in the market. And finally, if the business venture is going to be profitable in the long term. To take a look at all of these, you need to understand whether. So as we were discussing, the assumptions that you take for doing a valuation, that is the two fundamental numbers that you take is the cost of capital and the growth rate of the business. Now, the cost of capital will anyway be decided by the government in question. It will be decided by the repo rate. We will try to understand what the repo rate and the reverse repo rate are. And after that, it will also be decided by the cost of capital will of course be decided by the repo rate, and the growth rate will also have some element of the growth or growth rate of that economy. For example, a rapidly growing economy will have companies that are also growing faster on average than a country in which the growth rate is lesser. So these two fundamental numbers of valuation will of course come from economics itself. Apart from this, you will also see there is competitive advantage. So if you are trading in gold and your country is a gold rich country, or if you are trading in diamonds and your country is a diamond rich country, then of course you will have higher profitability because the raw material cost is lesser. Apart from this, the long term profitability and risk assessment, all of these are functions again of the economy. Now, coming to the main chunk, that is the relevant part of the, let's say, PIs that will be around economics, is your GDP. Now, once the budget comes on 2nd of February, I believe, we will see what the GDP growth rate target is and what is the, let's say, projection for GDP. What was the GDP of last year? How is the government planning on increasing the GDP? Now, the first question is, what is GDP? GDP is the gross domestic product. It is the sum of all the expenses and consumption in a economy. There is a formula for this: the government spending plus individual spending. Apart from this, the exports minus the imports. These all things makes the GDP of a country. So why do we need GDP? GDP tells us what the market size of the market that we are entering into is. Okay. Apart from this, if we have an option of going into a market, should we look for a higher GDP or a lesser GDP? Of course, we go for a higher GDP. The key differentiation also comes in GDP versus GDP per capita. If you want to, if you have two scenarios. One is a country with high GDP, other is a country with high GDP per capita. If you are in looking for to export or looking to do business of a premium product, then you go for GDP per capita country. And if you want to go for let's say a product which is more mass scale, like maybe the Pulse Candy, then you go for GDP because it is again the size of the entire market. Now, after this, we come to its implications. So, if you are trying to enter into automobiles market of India, how will you do that? You will first take a look at uh, the GDP, the Indian GDP, that will be somewhere around $4.5 trillion. Okay. Then you will start breaking it down, that how much is the size of the automobile industry, then how much is the size of the travel industry. That all insights you will get from the GDP. After this, from this market size, you will project your revenue. Okay. Now, there is also one more thing, that is financial risk assessment, country risk assessment. This much is understood that if a country has greater GDP, then the chances of it going down reduce. So that is why many a times India is looked upon as a good market, because India is too big to fail and a rapidly growing market too. Now, what is inflation? So this much we can understand, that 100 rupees 20 years back was not able to buy us goods as much as 100 rupees. Today, 100 rupees are not able to buy us as many goods as they used to buy us 10 years or 20 years back. Why did this happen? Because see, rupee is not fixed in the world. The government keeps printing more and more rupees every year. So if we were to go by supply and demand, the goods that are there in nature, for example, gold is fixed, okay? More or less the amount of steel that is there in the world is fixed. Everything in the world is fixed, which grows at a very steady rate, not much. Gold is constant. But the rupee is increasing each and every year. So what is happening is the supply of rupee is going up. Okay. The demand of rupee is always there. So if the supply is going up, the demand is also mostly going up only of rupee. Then what happens is that the price of rupee is coming down. Why? Because if the supply of anything is going up, then the price of that commodity, that product will always come down. Now, when this happens in the long term, what happens is that the currency itself devaluates. Earlier, 100 rupees was worth, once upon a time, hundreds of years back, was equal to 1 gram of gold. Now, in 100 rupees, you will not even get 0.0001%, 0.0001 gram of gold. Why is this? Because at that time, the number of rupees in the market was just, let's say, 100 CR. There are only 100 CR rupees in the market, just an example. But now the amount of rupees in the market is much higher. So what happens is that the value of rupees goes down, whereas the value of commodities go up or they remain the same. This is called inflation. So what does inflation do? Inflation is called a silent killer. Why? Because if you just keep 100 rupees with you in your hand, then today you might have been able to buy 10 Parle-G biscuits with it, but 20 years down the line, the number of Parle-G biscuits will just be 5. Why? So what it did is it reduced your purchasing power. It distorted your returns and it impacted the interest rates. So if you take a look at the market grows at 13%. Where does this 13% come from? The economy grows by 6 to 7%. The rest comes from inflation. Okay, that is why this 13% returns are there on the stock market. If the inflation was zero, then this number would only be around 6 to 7%. So what it did was it distorted the returns. In reality, I was only getting 6% returns. My 100 rupees worth of gold was only becoming 106 rupees. But because the inflation, the price of rupee also went down, the inflation also was there. So what it showed me was that the price again went up by 13 rupees, whereas it only went up by 6 or 7 rupees. So what does inflation do? Inflation reduces your purchasing power and distorts the returns. Next, there are 3 inflation scenarios that you must know. This is very important. First is inflation, that is normal price rise. Even in a healthy market, there is some amount of inflation that is necessary. Now, why will that happen? Because if there is no inflation in the market, if the price of a commodity is same, then there is no need for you to buy it today. You might decide to buy it 2 years later because the price is same and you might do some business with it, you might earn more money on it, so you will not consume that money. If the price goes down, then what you will do is, this year you were getting a refrigerator for 100 rupees or 10,000 rupees. Next year it will be of 9,900 and 5 years down the line of 9,000 rupees. So what you will do is you will buy the refrigerator 5 years later. So the demand will come down. People will not work as hard. So for the people to keep working hard and keep generating demand in the market, what do you need to do? You need to have a healthy 2 to 6% inflation in the market. Now there is another scenario. This is healthy. There are bad things also, bad scenarios too. For example, stagflation. Stagflation is when there is high inflation, but the economy is not growing. So people are not earning more money, or their lifestyle is not improving. Okay, but their paycheck is getting larger. This is also not a good situation to be in. And what happens in this scenario is that the governments have to instill economic growth without increasing the inflation. And then there is hyperinflation, when the inflation is like 700, 800% every month. A popular case of this is Venezuela. Okay, if they ask you where can hyperinflation be seen, you can always say Venezuela or Zimbabwe. Hyperinflation is bad because you don't even know what your money is worth. There is a very popular case that once, because the inflation was very high, for buying a bag of bread, you'll have to take 1 bag of currency notes. So what happened in Zimbabwe or Venezuela was that someone was taking a load of money on a wheelbarrow, or let's say a cart. There was a lot of money, around a million or 10, 20 million. And what happened was that this wheelbarrow fell on the street. Now, instead of stealing the money, what the people did was they stole the wheelbarrow, because the wheelbarrow was worth more than the money that was kept on the wheelbarrow. That can be one of the best examples of hyperinflation. Now, I've already told you how it affects the discount rate. Discount rates is again the rate at which your economy is going, or the rate which you need to exceed in your returns, how it changes the interest rates, how it changes the returns, and how changes the real versus the nominal returns. Okay. Now coming to the concept of real versus nominal GDP. So you will always see that the GDP of a country can be seen in 2 ways, real and nominal. Now nominal means in name only. Nominal in itself means in name only, in number only, whereas real means what is underneath the number that you are seeing. So what every year along with inflation, what happens is that the GDP is growing. Now the rate This growth can be seen because of two aspects. Okay, GDP grew like this. This one was the real growth in the economy. That is more money earned by the country. There was more labor that happened in the country. More goods got produced in the country. Whereas there is an element of the price rise. The GDP in itself is measured in rupees and then into dollars, but the value of rupees is also going down. So the amount, because more rupees are printed, more money is spent because of that printing aspect. So there are more rupees in the market now. So what happens is whenever you measure GDP every year, there is going to be a certain amount of growth there. Why is that growth there? Because mm, you have anyways increased the number of rupees in the market. But is that growth real? No. So for example, in 2011, the growth rate, the GDP of India, just an example, was 1 trillion rupees, $1 trillion. This is just an example. Okay. In 2025, it is 4.5 or 4.6. 2026, it is this much. Now, just taking an example, these are not real numbers. But do you think all of this 4 or 4.6 trillion is value addition or more goods produced in the country, or is there some aspect of inflation too? Of course, there is aspect of inflation. So that is why whenever you see economic growth rate, there are two numbers. One is real, that is the total GDP growth minus the inflation part is real, whereas the total GDP growth in itself is called nominal. So nominal minus inflation becomes real. This is the simplest concept that you can tell the professors in the interview. Now, how else does it affect the business cycle, the economy? What I mean is, how else does the discipline of economics affect the business cycle? So, if you have seen the discipline of mathematics, there is a thing called the sine wave. It always goes like this. Now, I will tell you a story. Time for a quick story. The grandfather of economics, um Will Smith, said that market keeps going up and down, and in the long term, the prices stabilize and everything becomes good because there is the invisible hand of the market. Invisible hand is that if the supply is too much, okay, then the prices will fall down. Then the people who are trading in that will not continue to trade in that because there is no profitability. And because of that, what will happen is then the supply will again come down. When the supply comes down, then the price goes up, and then more people enter that market, and when more people enter that market, then the price again goes down. So this is called the business cycle. Now after this, there was the Austrian school and there was Keynes, who said that in the long term we are all dead. What we need to do is we need to have banks and everything who will accelerate this process and provide us a buffer, so it doesn't happen that for 50 years we had immense boom and for the next 50 years everyone is dying of a hunger because there is no food in the world. So this is called a business cycle. Business cycle is the constant growth, then peak, then decline, and then repeat process that happens in an economy. What you have to do is you have to see which economy or which aspect of the economy is going through this growth phase, and you have to climb on this growth. Whereas the thing that is declining, you have to ensure that it doesn't decline or you jump to a different growing market. Now, these are just the four phases: expansion, peak, contraction, and then trough. So trough is a physics term in physics and chemistry. So it's peaks is on the top and trough is at the bottom. So what will we get out of this? You see different commodity prices. Apart from inflation, the price, if you reduce inflation, then the price keeps going like this in most of the commodities, minus the inflation, if the demand is constant. So what you try to do is you try to jump here and then come back on this part. You sell here and you buy on this part. It's called buy low and sell high. Now, what is the monetary policy? So as I told you, in the long term, we are all dead. What happens is, just a quick recap. When there is a market that has freshly started, there are a lot of people in the market. A lot of people in the market, what they do is they create a lot of supply. A lot of supply causes the price to go down. Okay. Then when the supply goes down, what happens is that the people exit the market. Now there are not that many people. So then again, the supply is less. When the supply is less, then the market is again going up. When it peaks, then what happens is that the people again enter this market because there are a lot of people, a lot of supply, then it again goes down. This is the cycle. Now this cycle, according to Adam Smith, will continue to dampen, and what will happen is that we will have stability in the world in the long term. But again, as Keynes said, in the long run, we are all dead. No one is here to see the long run. and you don't even know if the theory will work, even though there is evidence that it will work. So what happens then is that the governments try to make these crests and troughs or peaks and troughs not this harsh. Otherwise, what will happen is 1 year, 1 decade, or 1 century, you will have a lot of plentiful of things. For example, there is a lot of gold, there is a lot of services that are there, there are a lot of cars. And after that, when the market goes down, then everybody is begging on the streets. So to avoid that, what government does is it caps the growth and caps the downfall in a strict or very welfarist manner. How does the government do that? Government has two arms. One is the monetary policy, which is taken, which the central bank manages. Monetary policy is managed by the RBI. What does RBI want? RBI want that the inflation should be in check. Okay. But if the inflation is in check, so the government is printing less money, then you don't have more money to invest in new businesses. Okay. So just understand this with an example. You are living in a hostel. Okay. You need money from your parents. If they stop giving you money, then of course you will starve. You will not be able to live your life. But if they give you too much money, you will become spoiled. You will not be earning your money. The parents of children have a job to give them only the money, or only a little bit more than the money that is required for their survival and for them to start earning on their own. Okay, this is the job of RBI. RBI doesn't want the child to become rotten, to become spoiled, and not do anything on his own and just live off the money that his parents are giving him. Okay, whereas then there is the fiscal policy. Fiscal policy is by the government or the Ministry of Finance. What it wants to do is it wants the economy to grow. For example, you want to earn. Okay, what you have figured out that you want to do a 20 lakh rupees degree. Someone might have figured out that they want to invest rupees 1 cr in that they want to invest 1 cr in a business. Now, if you had the freedom to do as many 20 lakh rupees degrees as you wanted and in infinite time, would you do work hard for an MBA? You wouldn't. If I had the option of investing 1 cr in every business that I wanted, I would not do the due diligence and the hard work. So when these two forces combine, of the parents or the central bank uh, trying to reduce the amount of money that you're getting, whereas you are trying to increase the amount of money you are getting, you get the perfect amount of money that is required for you to work on yourself and start earning proper money. This is the dance that happens between the fiscal policy and the monetary policy. Now, how does the monetary policy decide what is going to happen in the country? How does the central bank do that? It does this by 3 or 4 factors. First is the repo rate, then is the reverse repo, CRR, SLR, and open market operations. What is the repo rate? So, if you are in a bank, you need money. You need money to give to different people. Well, how does a bank operate? It takes money from the common public, keeps them in the saving account, keeps some of the money with itself, and loans out the rest of the money. So, what does the repo rate do? The banks, many a times, what they do is they need money from the Reserve Bank of India, because they again want to give it out to someone else. So what does Reserve Bank do? Reserve Bank decides the repo rate. It's the rate at which RBI will give money to the bank, that is maybe HDFC. HDFC wants 2 crore rupees to give to Mr. Satyasaran. Now HDFC, what it will do is it will ask RBI for that money. RBI will be like that, I will give it to you at 6%. Then I will get it at 9%. Okay. Now, if the government wants that there should be more money in the market, so what it will do is it will bring money from the future to the present. How will it do that? It will reduce the interest rate. If the repo rate goes down, then more and more people will be wanting money to take money because the interest rate is less. The future money is coming to the present because right now the money was less. They decided to borrow money from the future. You have a lot of money now, pay it back to me in the future. So if the repo rate comes down, the demand, or said there's a supply of money, the supply of rupees in the market goes up. What is the reverse repo rate? If RBI needs money from the bank, if what RBI is also borrowing from the bank, so that there is not a lot of money in the market. Otherwise, if there's a lot of money, the inflation will go up. It will skyrocket. It takes money from the banks too. What it does then is it takes money from the bank at a certain rate of interest. That is called the reverse repo rate. So repo rate is the money at which RBI is giving money, whereas reverse repo is the rate at which the RBI is taking money. Now, Just a quick trivia. Do you think repo rate is greater or is the reverse repo rate greater? So as you can see, the um, so take a pause for this. We will come back. So yeah, welcome back. So the repo rate is always higher than the reverse repo rate because see, if the reverse repo rate was, so what happens is that the RBI gives money to it at 5%, okay, and then it borrows at 4%. That is the only case where the case when the bank can function. If this rate was higher, if this was 6%, then what it would have done is it would have taken money from RBI at 5% and then given it back to RBI at 6%, and it would have earned 1% margin. It could have been doing that indefinitely, and the economy will not make sense at all. Then there is two other ratios, that is CRR and SLR. Okay, so CRR is cash reserve ratio, and SLR is the statutory liquid ratio. Please write it down. So whenever there is a bank, it took 100 CR from the public, from you and me. Now it cannot give all of 100 CR to as loans. Otherwise, when people come to ask for money, how will they give it to them? How will they allow withdrawals from savings accounts? So CRR is cash reserves ratio. So what CRR does is the bank like SBI and all have to keep some money with the RBI because it is the money of the people. So CRR tells them how much money, amount of money do they need to keep with the RBI, whereas the SLR tells them how much money do they need to keep with themselves in liquid form. So if it has 100 crores and the CRR is 17%, then 17 crores will be kept with RBI at the reverse repo rate. Whereas SLR tells them that if you have 100 crores, keep 3 or 4 crores strictly as liquid, as cash, gold, or these things, so that you can return the money to the people whenever they want them. These four. So if the CRR, cash reserve ratios, goes up or SLR goes up, then there is lesser money in the market. If there is lesser money in the market, there is lesser inflation. If the repo rate is higher, then there is more money in the market because people are willing to take more loans and future money is coming to the present. So again, increase in an increment in these two increase and decrease simultaneously. You will never see the case where the repo rate goes up and the reverse repo rate goes down. They both increase and decrease simultaneously. So whenever reverse repo rate and repo rate increase, then what happens is that people are borrowing more money, so liquidity increases and inflation goes up. When CRR and SLR go up, then the inflation goes down because the liquidity goes down. Apart from this, there is one more thing which is called open market operations. Open market operations is that RBI itself, what it does is that it sells some amount of gold or some amount of bonds in the market. RBI always has bonds. One was sovereign gold bonds, and there are other bonds of the government of India. If the RBI sells a bond is a promise that I will pay you back some amount of money in the future. If it sells a bond, then it takes a lot of money out of the market, or it's so when money is out of the market, then again inflation is going to come down. If it then takes back the bond or gives the money out in the, let's say, in the market in exchange for some different bonds or some different commodities, say for example, RBI decides to buy gold and it took gold and gave out money in the market. So money increased and then again inflation will increase. The key formula is money increases, amount of money increases, inflation goes up, amount of money goes down, inflation goes down. Now, I think now it's obvious how monetary policy will affect finance. Interest rate if changes, then the bond prices also change. If the borrowing cost, interest rate is same as borrowing cost, and this is also related to liquidity. These all will affect the corporate profits, bond prices, and the stock market flows. Now we understood what fiscal policy is, but once more, if we were to go into detail, see, government takes tax from the market. Now you might understand that if you take more tax from the market, then growth is not incentivized because after a point people are like I'm paying 30-40% tax already, why will I work harder? Okay. But if the government is taking no tax at all, then how will the government function? So you have to find that balance of taxing where people keep working hard and the economy is also stimulated enough to grow so that the people are, by the hard work of the people, that is the balance of taxes. Apart from this, there is also spending. So when government builds a highway, What it does, it incentivizes the factories to be there, them to produce more and export it outwards. Then what happens is the GDP grows, because if we remember the formula of GDP to be spending by common people plus the investments plus the spending by the government plus the exports minus imports. That is X. Now, if anything goes up, then what happens is like GDP increases. So fiscal policy, what they can do is they can affect these two things. Now, if we were to keep reducing the taxation, then the growth rate will keep going up. What will happen is that the money will be accumulated in the hands of a few people who are already rich. It will not be distributed. What government does is it occasionally increases taxes and then decreases taxes. That brings us to the two types of budget. Okay, the two types of budget can be a contractionary and a expansionary business budget. Sorry, a contractionary business budget is that is contractionary budget is when there is a lot of inflation and the government wants the inflation to be less, then the focus on growth is lesser, because then the priority is to reduce the inflation, otherwise the prices will go sky high and out of control. That is a contractionary budget. Whereas an expansionary budget, what it tries to do is it in increases the prospect of growth. Now, in a contractionary budget, what we can say is that the taxes mostly go higher. The government itself is not spending that much because it doesn't want more money in the market. Whereas in an expansionary budget, the government will reduce the tax rate. Why will it reduce the tax rate? Because then there will be more money in the market and people will be willing to spend and make new investments. After this, the government itself will also spend a lot more. Earlier it was spending less, now it's spending more. Now, another thing that we have to take a look, what we have understood till now, in addition to that, we have to understand one or two more things. When we take a look at business, particularly in international business, it is first is currency valuation. So just as government was doing things in the domestic market, increasing and decreasing the supply of rupee in the Indian market, it can also do it internationally. When the supply of rupee in the international market goes up, then the price of the rupee will come down. The dollar will get more expensive. If the amount of rupees that are there in the Indian market or in the international market come down, then the price of rupees will increase. Now, if you were to have a strong rupee, then what we can do is we can always take away all the rupees from the international market, and then the price of rupees will be very high. But then there will be a problem. No one will be willing to buy a rupee that is very expensive, because the number of things that you can do with a rupee is not a lot. And whenever someone says a strong dollar or a strong rupee, it doesn't mean that the value is very high, but the value is stable, so that people can trade with your currency with confidence that the value will not drop the next month or the next quarter. Now, coming to one of the final concepts, one is balance of trade. So you might have heard things like deficit in the market. India is mostly in deficit because what is balance of trade? It is the export minus import. Whatever India is importing is much greater than what it is exporting. That is why India is mostly in deficit. This is simply what balance of trade is. Now, if we were to take a look at different sectors, overall India is in a deficit, but maybe in case of rice, we are in a surplus. Maybe in case of tractors, we are in a surplus because we are exporting more than we are importing. Now, what is balance of payments? Balance of payments is a national ledger. Ledger, most of you might know what a ledger is. It has the entry of all the commercial actions that happened in the country. Now, balance of payments account will have three accounts. These you can see on the screen. But what is important is that a balance of trade is more focused on the services, the commodities, and the products that you are providing. Whereas here, you can also take a look at the investments that are there. Just like Japan investing some amount of money in the the bullet train project. This is explained by the balance of payments. But more important here is the balance of trade. We always want a country to be in a budget or a trading surplus. Now, these are some other concepts that we have to look at. Now, if we were to take a look at the rupee or any currency, so to say, it is again similar to what we were talking about, the boom and bust cycles, the boom and bust cycles. Now, the value of the rupee right now might be at 85. 85. Let's keep me. Now, naturally, if we were to look at it with every news, for example, some company making profit, COVID-19, other news, India buying oil from Russia, all of these news, the price of rupee will be very unstable because news keeps happening daily, and so does the news changes daily, and so does the confidence of people. What the RBI does is it manages to stabilize it, not fix it at a rate, but stabilize it so that people have still confidence in the rupee and keep trading with India. Managed float. Then there is the fixed versus the floating rate. Fixed rate is that the government tells you that I will give you this many rupees for a dollar, whereas floating rate is the amount of money that you will be able to get from the free market. So the government says that for 1 rupee I will give you $1 I will give you 80 rupees. People will buy it. But after some more time, when the rupee becomes 100 rupees, if the rupee becomes 100 rupees, then for $1, people will be expecting 100 rupees. And if the government is just giving 80, then the people will not be giving dollars to the Indian government. So this is fixed versus floating. Appreciation versus depreciation again is if the price of the rupee goes up, okay, or price of the rupee goes up doesn't mean that $1 is now equal to 100 rupees. No. If the rupee is right now is equal to $1 is equal to 80 rupees, then price of rupee going up means that 75 rupees is the new price of a dollar. This means that the value of rupee increased. So currency appreciation is that the value of rupee increases, whereas depreciation is that it became 85 or the value decreased. I'm talking about the value, not the price of dollar. 80 rupees is the price of dollar, not the price of a rupee. And purchasing power parity is that $1 that is 60 rupees, 80 rupees. 80 rupees will not be able to buy you as many things in America as they are able to buy you in India. In 80 rupees India, you can get a Aloo Tikki burger, whereas in McDonald's USA, for $1 you will not be able to get a burger. You will always have to spend $2. That is purchasing power parity. What is currency risk? Again, the currency can fluctuate like this. If you'd made a deal at this point that you will get 10,000 rupees and then rupees tanked or rupee, let's say, didn't do that well, then when you get those rupees, it is not that much. That is again a risk. Okay. Now, if you have learned all of this, then of course you will be able to find out your way through these interviews. If you have any doubts, let me know in the comments. I will be checking the comments to answer your doubts. If you have any feedback, be sure to leave that too. Don't forget to like, share, and subscribe to the channel. And yeah, happy preparation. Best of luck.